Hello, good morning and also good afternoon and good evening for those in different time zones. My name is Mehmet Tosun. I'm the Director of International Programs in the College of Business, and I'm also the Professor of Economics in the Department of Economics in the College of Business. This lecture series is a new initiative under our new research lab, the Nevada Global Business and Economics Lab, or MB Global. It is my great pleasure to have Professor Jim Alm today as our distinguished speaker in the tax policy lecture series. Professor Alm is currently the president of the National Tax Association, which is one of the oldest and biggest networks for scholars and professionals in the field of public finance and taxation. He is also a professor emeritus of economics at Tulane University. Previously, he was chair of the Department of Economics at Tulane. Before Tulane, he was the Regents Professor in the Department of Economics at Andrew Young School of Policy Studies at Georgia State University. He also served as Department Chair and Dean of the Andrew Young School at Georgia State. Professor Alm has taught at Syracuse University and at the University of Colorado Boulder before. He received his master's degree in economics from the University of Chicago and a PhD in economics from the University of Wisconsin-Madison. Professor Alm's research is in public finance, and much of his research has focused on behavioral responses to taxation in such areas such as the tax compliance, marriage tax, tax reform, opportunity zones, housing choices, economic growth, and corruption. He's also worked on fiscal and decentralization reforms in many countries around the world. His research has been published in leading journals in economics, including the American Economic Review, the Journal of Economic Perspectives, Review of Economics and Statistics, Journal of Public Economics, and National Tax Journal, among many others. He's also published 11 books. He was the long-serving editor of the Public Finance Review, a well-known and respected journal in public finance, and he's also served on numerous editorial boards. He's been the president of the Southern Economic Association, and he just became the president of the National Tax Association in November 2020. I'm very pleased to have Professor Alm in our tax policy lecture series. Today's lecture is titled Tax Policy Measures to Combat the SARS-CoV-2 Pandemic and Considerations to Improve Tax Compliance, a Behavioral Perspective. Professor Alm, thank you very much for joining us today. As we discussed before, you have about an hour, up to an hour to present, and your presentation will be followed by a Q&A session that will go for about 15 minutes. And we expect to end no later than 11:30 Pacific Standard Time or 2:30 p.m. Your time. Jim, you have the floor.
Thank you very much, Mehmet. I won't say that Mehmet is an old friend because that ages both of us. I will say that he is a longtime friend. And so thank you very much for the invitation. It's an honor to be here and a pleasure to be talking to everyone. I want to thank also the people who are making this happen beyond Mehmet. And those are Ashley and Michelle and Holly, who are behind the scenes and are, if there are technical problems, then we will point the finger at them, but I'm sure there won't be. So thanks to them for making all this happen. Let me share my my screen in my presentation. I've actually debated whether or not this kind of talk is best given without a PowerPoint presentation. And there's something to be said for that, because I think that most people are not particularly good at multitasking. And so I'm asking you to listen to me and to read at the same time. But if you have to choose one or the other, it's probably better to listen to me. And I'll apologize in advance to everyone. The standard line that I give my students, and I still have students, even though I'm a professor emeritus at Tulane, is not to make their presentation slides too complicated and too busy. And I am violently violating that in this. So I thought it was important to get some of this information in front of you. And so that's the rationale for it. But I recognize in advance that these are not, many of them are not simple slides. So what I want to talk about today is some joint work with some good friends, Kay Blaufus, Martin Folkman, Eric Kirchler, Peter Morden, Nina Olson, who recently stepped down as taxpayer advocate, and Benno Torgler, all names that many of you should be familiar with. It's not any news that to anyone here that we've gone through some trying times, and we're still going through them, all related to the coronavirus, the SARS-CoV-2 pandemic. And governments have taken remarkable measures to deal with this along multiple policy dimensions. I want to focus on tax policy dimensions. In this paper, we're analyzing these tax policy choices, and we're doing so looking at two main questions, and we're looking at these two main questions mainly from a behavioral economics perspective. So the two main questions that I want to deal with are: what is the impact of tax policy measures taken to combat the economic consequences of the SARS-CoV-2 pandemic, in terms of the perception and evaluation and the behavior of citizens? Now, there's lots of ways in which we can evaluate these policies. What we're going to be doing, though, is evaluating them and evaluating the reactions of people, primarily in terms of which are likely to presumably achieve the goals of protecting consumption and encouraging business cash flow. But also, and there's the second question, how do all the reactions that people are making and firms are making to these tax policy measures, how will it affect their willingness to pay taxes? How will it affect their tax compliance? And what needs to be done in the future to ensure a commitment to pay taxes? Again, throughout all of this, we're taking a behavioral economics perspective. And I will say that given my own research interests, I'm going to focus probably a little bit more on the compliance impact of the policies rather than on the consumption or investment or cash flow or other aspects of the policies, but I will talk about those. And again, the perspective is going to be evaluating these from a behavioral economics perspective. Are these policies going to achieve or not achieve their goals? And what are the subsequent effects on compliance? So the roadmap of this presentation is fairly simple. I'm going to start with a review, an overview of the tax policy measures that governments have taken in response to the crisis. I will include here a discussion of what not simply the United States has done, but what governments around the world have done based upon OECD data that have been recently updated. But I'll go through this fairly quickly. And then I want to move to the questions that I posed at the beginning. How do people perceive these policies in terms of their effectiveness in achieving the stated goals? How will people accept these tax policy measures, and what will be the effects of that acceptance on compliance? And use that then as a springboard to talk about behavioral strategies to maintain citizens' willingness to cooperate and to pay their taxes. And finally end up with some conclusions. And as is always the case with most of my presentations, the conclusions are going to be focusing kind of on what we know and what we don't know, and what are some possible future strategies for answering the questions that we don't know, for future research, if you will. So the first point, let's look at the tax policy measures in response to the crisis. Again, these have been along multiple dimensions. And I'm not going to go into detail on all of these. And here's where there's a particularly busy slide here. I don't expect everybody to read every single bullet point here. But according to the OECD and according to what most of you probably know about US government responses, there's been a variety of tax policy measures. Now, what government's done has gone beyond tax policy measures, obviously. Operation Warp Speed in the United States for the vaccination program and so on. The ways in which these policies, other government policies might affect diversity and inclusion and social equity and such. Those are important considerations as well, maybe even more important than tax policy. But nonetheless, from a tax policy perspective, what has government done? Well, they've increased business cost subsidies, they've extended filing deadlines, they've given tax refunds, They've changed specific granular features of the tax code on tax business loss offset provisions. They've given wage subsidies. And again, this is not simply the US, this is around the world. They accelerated depreciation provisions and given bonus depreciation provisions. They've given tax incentives for R&D, like to Operation Warp Speed. Tax rates have been reduced both in the corporate income tax and in value-added tax. Specific sectors have had taxes reduced. There have been, in particular, direct cash transfers to households. These are what are getting a good bit of the publicity, and extended, enhanced unemployment benefits for individuals. Individual tax refunds, that's a major component here. On and on and on and on. Now, it's hard to keep all of those straight. So here's a different way of thinking about them. Ignoring automatic stabilizers and how those those are not discretionary tax policy changes, and any major structural changes that governments enacted in response to the COVID-19. These are all tend to be short-term policies, and they fall into four main areas that depend upon their main objective. And so one area is policies to enhance firms' liquidity. Second, policies to support employment. Third, policies to support investment. And fourth, policies to support consumption. Specifically, these include the following types of policies. So to enhance firms' liquidity, this would include things like, again, enhanced loss offset provisions, enhanced tax refunds, non-payable grants or subsidies for non-wage business costs. This would include, for example, Paycheck Protection Program, $350 program that was passed part of the CARES Act last March. Tax filing extensions, tax rate reductions, tax waivers. And the specific provision is in the first column, and all the countries that have followed these, have enacted these, according to the OECD, and this is updated through the end of 2020. And so these are fairly current listing of countries. You can see that for particular tax policies like tax filing extensions and tax payments defers, virtually every country in the OECD out of 100+ countries have enacted them. Second measure, policies to support employment. Enhanced or extended eligibility for sick pay, enhanced tax refunds or forgivable loans. That's also where you could classify the Paycheck Protection Program. Special tax deductions, tax exemptions, tax SSD stands for Social Security contribution waivers, wage subsidies. And again, you can see the huge array of countries that have enacted these. Policies to support business investment are fewer, even though these can be quite expensive. Accelerated bonus depreciation, corporate income tax, CIT is what that stands for, rate reductions. Increased research and development tax incentives, reduction of withholding taxes, tax credits and tax rebates. And in particular, what gets most of the press in the United States, I think, are policies to support individual consumption, to make sure that people who have lost their job, these are a form of social insurance. These are not so much stimulus payments, I think, as relief payments. So cash transfers for households is the major component of U.S. Policies to support consumption. Enhanced or extended eligibility for unemployment benefits. Ditto, it's a major component of U.S. policies. Tax credits, tax waivers, VAT rate reductions, those don't really apply to the U.S. And so when you look at all of these in total, these programs are enormous. Just focusing at the U.S. The U.S. has enacted, I'll go through this quickly. The U.S. has enacted 5 different phases of coronavirus relief, going back to the very first one, a relatively small one, called the Coronavirus Preparedness and Response Supplemental Appropriations Act last March of $8 billion. A bigger one was passed about 2 weeks later, the Family's First Coronavirus Response Act, $192 billion. Serious money. But then in late March, a week later, is the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, $2.2 trillion. $2.2 trillion. Then in December, in the last stages of the Trump administration, a $900 billion program, Consolidated Appropriations Act, was passed. And then obviously what was just passed a couple of weeks ago is the American Rescue Plan Act of 2021, $1.9 trillion. So in total, we're talking well over $5 trillion of relief payments in the United States, all of which have amounted to, if you compare the US to other countries and the magnitudes of their responses, the US is only a little bit behind Japan in terms of the magnitude of these relief programs relative to GDP, close to about one-sixth of GDP, of current GDP has been devoted to relief programs. Japan is a little bit higher. Australia is about the same, but countries, OECD countries like France and Germany and Italy, they're about 10% of GDP. The US is about 16, 17%. And some countries like Indonesia or South Korea or India are much lower, 2 or 3%. So these are, but nonetheless, major initiatives. And so the question becomes, how do people perceive these? How do people perceive these in terms of their effectiveness? So this is the first research question. This paper, by the way, has just recently been published. I'm happy to send a copy to anybody who's foolish enough to want a hard copy of it. My email is on the first slide, so you can send me something if you wish. There's a pretty detailed discussion in the paper in which we evaluate these policies. And again, the perspective is behavioral economics. And so we want to look at this in terms of salience. These are behavior economic notions popularized by Kahneman and Tversky and now pretty much widely accepted by most economists and psychologists and such. People are more likely to change their behavior when the incentives are highly visible. Complexity. People are less likely to change their behavior if they can't understand the incentives that are being presented to them, the tax policy. Framing. People are affected, surprisingly so perhaps, in their behavioral responses by identical policies that are called something different, how the policies are framed. If a policy is framed as a gain, they respond in one way. If it's framed as a loss, even if the financial consequences are identical, they respond differently. If the policy is portrayed as a tax versus a fee, they respond differently, or a charge. So the way in which a policy is presented matters in significant ways. And finally, people are influenced by the timing of incentives, especially when they use mental accounts. If something is presented in a way that the people will put in their quote current mental account, they will respond differently than if they think it's more of a permanent policy change. So, for example, remember those 4 different ways in which we were classifying government policies. Let's focus on just a couple of them. Tax policies to support consumption. Behavioral economics research supports pretty strongly across the board that due to loss aversion considerations, participants are willing to spend more if a tax reduction is framed as a gain, as a bonus, instead of as a foregone loss. So tax reductions framed as an increase in monthly income, as a gain, lead to more spending than if they were framed as a reduction of the monthly tax burden, a loss reduction, largely due to loss aversion principles. So what this suggests is that if you're trying to design policies to get people to spend, to replace some of the aggregate demand that's been lost because of people being laid off and is being replaced by the relief programs, you should frame income tax changes as a gain rather than as a loss, which is what was done in the US for the most part. Second, due to timing considerations, especially via mental accounting, the proportion spent of tax refunds administered as one lump sum is less than tax refunds of the same amount refunded monthly, because lump sum payments tend to be saved because people put them in their mental account for the capital account. Monthly payments tend to be classified by individuals more as a one-time, and they're classified in their current account. That tends to be spent. So what that suggests is, salience considerations aside, give income tax refunds as installments, as in Germany, not as one lump sum, as what was done in the US. So if we're trying to learn from experience, we should learn more from Germany in this regard than from the US. Due to salience and complexity considerations, consumption taxes that are not included in the price, but instead are added at the register, are largely ignored. Raj Chetty and his colleagues have some important work on that. So this is not so relevant for the US, given where tax rate changes tend to have occurred. The effectiveness of a VAT rate reduction is higher if tax inclusive prices are displayed. And again, due to salience and complexity considerations, small differences are ignored and don't change behavior. You want the changes to be noticeable. So make sure that the tax reductions are large enough to be noticed. So what about similar considerations as applied to tax policies to support investment? Well, again, the same types of considerations about salience and complexity and accounting, mental accounting, and so on. So what this suggests is if you're really trying to get corporations to spend some of their relief, then due to salience and complexity, it turns out corporations focus much more on financial accounting numbers, which are beloved by accountants, rather than the numbers that are beloved by economists, such as marginal effective tax rates and such. So you should give, if you're trying to encourage businesses to spend their investment incentives, you should give the investment incentives in ways that affect the effective tax rate, the accounting tax rate, like tax credits, which is what was done in Italy, and not the marginal tax rate, which is what is affected by things like accelerated depreciation or loss carryback provisions, because those don't show up quite as much in those accounting measures, at least right away. That's what the US did. Those are going to be less effective. Furthermore, and again, this relates to the way in which these decisions are made within businesses. Due to salience and complexity considerations, organizations focus more on changes to the tax base, which also relates to the point above, rather than changes to the tax rate. So instead of giving income tax rate reductions, you should make sure that the changes are given via base reductions rather than rate reductions per se. I'm sorry, just the opposite. Tax rate changes are more noticeable because those are headline measures that businesses can pay attention to. So give the incentives to business in the form of rate changes because they notice that, and base changes are a little bit harder to calculate. Due to salience and complexity considerations, the take-up of incentives depends on a firm's tax literacy. So you don't want to make things too complicated, at least for smaller businesses. Paycheck protection programs are pretty simple in that regard. So keep investment incentives simple, especially for firms without investment and sophisticated tax advice. So what does this suggest? This suggests that there's kind of a mixed evaluation of what the US has done and what other countries have done, at least measured in terms of behavioral economics considerations. The same dollar amount of relief could have encouraged more investment spending, more consumption spending, better protection of payrolls if some of these behavioral economic considerations had been considered. Some countries were more effective than others. The US actually did a decent job, given that, to be honest, a lot of these policies were enacted on the fly. People were acting without knowing fully what they were facing. The government policymakers were acting without knowing exactly what to do. And so I think for the most part, and I'll come back to this later, a lot of these policies were enacted, if not especially well targeted, were enacted with some of these behavioral economic considerations taken into account. But not all of them. So what does this mean in terms of how people accept these policies? And what are the implications of that for compliance? Given how people and firms reacted to these tax policies, the perceived effectiveness of these tax policy measures will have a range of subsequent effects on tax compliance. And I want to emphasize that these effects go through various channels, but especially through people's trust in government. To help understand the ways in which the perceived effectiveness of these tax policy measures have affected, through trust especially, compliance, let me give a very, very brief review of the tax compliance literature. Again, if anybody wants to dive into this in more detail, I have some recent papers. One that is the first one, 2019, kind of a survey of this, of all these with my own somewhat idiosyncratic lessons from this literature, and then followed by a meta analysis of all the experimental studies that have been done trying to extract lessons. That's the paper with Antoine Malazou that is forthcoming in experimental economics. Again, I'm happy to send these along to people. And I actually I have a whole presentation on this literature that I'm going to summarize with these 5 bullet points rather than going into all the details. This is a very brief summary of this entire literature that collapses the theoretical and empirical and experimental literature into 5 main lessons. The first is that individuals are influenced, as predicted by the standard compliance theory, by narrowly defined and individually based financial considerations like audits and fines. If you ramp up audit rates and you ramp up fines, people tend to comply more. But they're influenced by non-financial considerations like sympathy or empathy or patriotism or emotions or guilt or shame or morality. I just listened to a paper this morning, in fact, that talks about the Kantian deontological motivation for people simply to do the right thing, even if there's no obvious payoff to them in any form, based upon social norm considerations. Individuals are influenced by information and the ways in which they process information in ways that are not always predictable and are not always expected. And again, there's much more that lies behind these bullet points. But individuals are also influenced by social considerations like trust, like social norms, like provision of public goods with tax payments, like voting, by what their neighbors are doing and how they think their neighbors are responding. And of perhaps most importance, there's not simply one representative individual that we can use to classify all types of responses to any policy measures related to compliance. Individuals cannot be represented by a single representative agent. People are complicated. They're motivated by lots of different factors, and the same individual may respond differently to things at different points in time. So we can't look at an average taxpayer. We need to take into consideration the whole full house, if you will, of individual behaviors that represent the complexity of people's decision-making. And what that leads to then is what I'm going to call a full house of administrative strategies as well. How can those insights about individuals be used by a tax administration to improve compliance, especially during and following a pandemic like we have here? Well, as indicated by those bullet points, I'm going to give you 2 different perspectives here, 2 different frameworks that are really overlap quite closely. One of my own and one that some psychologists have developed. The first one is that all of these are based upon the notion that people are complicated and are motivated by many factors. Even so, all of this evidence suggests that detection and punishment as policies need to be present, but other tools need to be present as well. Tax administration should provide services to make it easier for people to pay, and the tax administration and government itself must be seen as trustworthy. Policies are more effective in that environment. So power or enforcement and trust and services must be part of an overall strategy to ensure compliance. In other words, we need a full house of administrative strategies to address the full house of individual behaviors. And this can be used to develop 2 very similar overlapping frameworks. One is the slippery slope framework of Eric Kirschler, which characterizes the interaction climate between taxpayers and authorities. And that's what shapes the willingness to cooperate, based upon trust and power, not so much services, but trust and power. In a framework where people trust the government, taxpayers are willing to cooperate voluntarily. In a framework where they don't trust the government, you need to enforce the tax laws with fines and audits and such. So tax compliance depends upon the power of the authority and the trust in the authority, with both dimensions moderating each other and determining the level of compliance. An authority with a high level of power, determined by frequent and effective audits, high detection probabilities, severe fines, affects enforced compliance. An authority that is trusted by people, determined by factors such as fair procedures and fair distribution of tax burdens and favorable attitudes toward government and trust in government, particularly affects voluntary compliance. One can take these precepts and also, and this is kind of my preferred approach, and what I've developed in a variety of papers, to characterize government policy toward compliance in terms of three different paradigms: a power paradigm or an enforcement paradigm. If you want to improve compliance, increase detection and punishment. A service paradigm: there is a role for tax administration as a facilitator and a provider of services to taxpayer citizens. So improve the services of the tax administration by becoming more consumer friendly. And regardless of whether you're using power, enforcement, or services, people are more likely to respond to if they believe the government generally and the tax administration specifically are honest. Trust in the authorities can have a positive impact. So change the culture or the social norm of paying taxes. So given these frameworks, what are the likely effects of the various tax policy measures on these dimensions of tax compliance? Using these two very similar frameworks and emphasizing trust and power and services for that matter, as well as individual traits and situational characteristics. So consider, first of all, the impact of these measures on the trust in the authority. Starting with several dimensions. So do people perceive the measures that government has enacted as effective? Well, it varies. It varies. In the United States, for example, other countries, I think, if we're talking about New Zealand as an example, I think the perceived effectiveness of the measures that government has enacted, which fall into those four categories, was widely seen as being very effective. In the United States, I think it's a mixed record. In fact, the U.S. government response, I think, has been widely seen as largely ineffective in a lot of dimensions, and this may well have cost Trump the election. People did not see these measures broadly defined, but certain tax policy measures more specifically in this paper, as being effective as stopping the spread. Now, there's things in terms of stopping the spread that go far beyond tax policy measures, but the overall perception, I think, of government in the United States is a somewhat inadequate response. What about the response of government measured in terms of, are these policies procedurally fair? Do people think they were treated fairly in the way in which these tax policy measures and other policy measures were enacted? Well, again, I think it's a mixed bag in the United States. Many groups, for example, went to court to sue their state governments about the way in which some of these policy measures were enacted. And this is not related to tax policy measures per se, but spills over to their perception of the way in which tax policy measures are seen as being procedurally fair. Groups went to the court over what they saw as disparate treatment. Religious groups, small businesses thought they were singled out, for example. Procedurally, they didn't think they were being treated fair. And again, this is not so much about tax policy measures per se, but nonetheless, it spills over to that. What about distributive justice? In other words, you think not in terms of whether procedures were followed, but whether the impact on you is fair. You are treated fairly in terms of your benefits and costs relative to others. Distributive justice. Again, which do people in the United States think that they were treated fairly in terms of distributive justice? I think it's a mixed bag. Again, groups have gone to court over what they see as disparate treatment. especially on shutdowns and essential workers and so on. And there's a widespread perception that some people, I could bring in some personal anecdotes here, but I won't, have received relief payments, even though by any objective standard, they maintain their jobs, they maintain their consumption, they maintained, they were working from home. They were not adversely affected in terms of their finances in any event by the coronavirus. And so I think the distributive justice is a mixed bag for the United States as well. What about retributive justice? Is it the case that people who have cheated have been penalized appropriately? Well, again, I think in the United States, focusing there, it's a mixed bag. Think simply about mask mandates. Did people obey those? No. But did people who were unfairly game the system to get paycheck protection loans or stimulus payments or extended unemployment benefits? I think there is a perception that people got away with things. People got away with things. So indeed, I think there is increasing and emerging evidence that trust is an essential feature of government responses here. Of any successful country. That is, social capital is enormously important, and the pandemics and its policies and its politics have had pervasive effects on trust. Some positive, like in some countries, some largely negative. And in fact, if you look at the economic literature, there is a huge expansion of literature of very recent studies that have demonstrated the role of trust in obeying lockdowns and such, and keeping the spread of coronavirus limited. This kind of goes back to, I don't know if anybody noticed that George Shultz, a remarkable public servant, an academic, had an op-ed right before he died, just in the last several months at age 100, where he said that the most important things I've learned, that was entitled "Trust is the coin of the realm." When trust was there in the room, good things happen. When trust was not in the room, bad things happen. Everything else is details. And that was reflected also in an op-ed piece by a New York Times columnist that said that, in particular, the effect of Donald Trump on trust, and I'm not going to get into the politics, but was corrosive. What he mainly damaged was social trust, the most important element in any successful country. There's a good bit of evidence from Darren Asamoglu, for example, and his colleagues. In high trust societies, people tend to flourish. In low trust societies, they generally don't. And this has shown up in some recent papers. I'll just mention a couple of them, but in particular, one by Durante, Geis, and Gulino that looked at civic capital and social distancing in Italy. Countries or cities and regions in Italy with greater social capital, as measured by blood donations and survey-based measures of trust and newspaper readership, were more willing to obey lockdown regulations and stay at home, social distancing, based upon individual mobility data from phone tracking. And that shows up in a number of other papers that look at similar measures of behavior as determined by social trust, social capital, and things like that. US doesn't look too good in that regard. What about impact of policy measures on power and enforcement authority? Well, in particular, what we have seen in the United States is that the budget of the IRS has gone way, way down. So the ability to detect fraudulent behavior through audits is diminished. On the other hand, much of the financial relief that was given to people was given in a form that establishes some kind of paper, or more accurately, an electronic trail. So that if you have received unemployment insurance, if you've gotten a $1,400 stimulus payment, or previously what the magnitude there, if you've gotten a paycheck protection program, you are in the system. And so the ability to monitor this, especially if the IRS had a budget, is significantly increased. So there is strong evidence, though, overall, that the pandemic and its policies and its politics have had a pervasive and largely negative effect, mainly through budgets, not through electronic trails, on the ability of governments to enforce the laws, especially with declines in administrative budgets. What about the role of individual traits and situational characteristics? Well, here we're talking about things like moral balancing. There's some evidence that people have kind of a moral balancing account that they want to maintain. And if they do moral acts in the first stages of the pandemic by social distancing and stay at home, they figure they've earned some credits, and that allows them to engage in less moral acts following later on in the pandemic. So that can have some effects. Unexpected events and such. Unexpected but severe events typically influence an individual's willingness to take risks. Unexpected unemployment has been shown to be an important driver of risk aversion, and that leads to more risk-averse behavior, and that leads to more compliance. Income losses lead to more risk-averse behavior, and that tends to lead to more compliant behavior. What about emotions? Well, we need to distinguish the type of emotions. There's an emerging area of research in compliance that focuses on the role of emotions. It's a fascinating area. If people are angry about the way in which government responds, they tend to cheat more. If they are fearful because of the way in which government responds, that leads to more risk-averse behavior and they comply more. People are influenced by what others do. If people see others cheating by not wearing masks, or they hear stories about their neighbors getting relief payments when their neighbors clearly don't deserve them in terms of any kind of financial need, that influences their behavior and they're more likely to cheat. And policies that are framed in terms of people are framed in terms of losses versus gains lead to different types of behavior. In the loss domain, people tend to be more risk-seeking, and that tends to increase tax evasion. And finally, there's a withholding phenomena in the sense that if you're paid, if you think you've paid more taxes than you have to pay because of withholding, then you will try to make that up in subsequent behavior, and that leads to more cheating as well. So there's a variety of and there's individual characteristics such as demographics and so on. If you look at all of these, this is kind of a table that summarizes the effects, and you can see the particular phenomenon, effectiveness of tax measures, procedural justice, distributive justice, retributive justice, detection probability, and all these different individual traits and situational characteristics. And here's the effect on compliance. Look in particular at the far right column. A green arrow means that it increases compliance. A red arrow means that it decreases compliance. And what you tend to see is the very disparate effects, very disparate effects. So based upon this, what are some behavioral strategies to maintain people's willingness to cooperate? I'm going to give you 10 different strategies. 11 different strategies that are based upon this analysis that I think we can draw upon and use going forward and looking backward about evaluating policy and designing new policies. First policy that I think emerges from this, first strategy to improve compliance going forward and to maintain people's compliance, is that the government needs to communicate its policies. By the way, the headline for this is, how can trust be increased? These are basically strategies to increase trust. And one strategy is to communicate quite clearly. A basic rule of crisis management is communication, to let people know what's going on and to let them know honestly. Again, I think without making political statements, it's clear that the Trump administration did not release all relevant information. It remains to be seen whether the Biden administration has. I think the early indications are they're trying to be more transparent about that, communicate. Second Similar conclusion. Justify clearly and transparently what you are doing. Economic stimulus packages, tax relief policy measures need to be justified and their forecasted effects clearly communicated. All of this communication based upon scientific evidence, evidence-based policies. Keep things simple. Third basic strategy. If you make it hard for people to understand, if you make it hard for people to get a shot, because there's so many different websites that you have to go to, people might be resistant to getting shot. Make it simple. I will say that the state where I am right now, West Virginia, they've been pretty good at it. Louisiana has done a decent job as well, my previous state. Fourth, provide services consistent with the service paradigm. Services are important and must be offered by the required authority. So the tax administration in particular should be a provider and a facilitator of services. IRS does, as evidenced by recent taxpayer advocate reports, does a mixed job there. Use controls and penalties. This is the enforcement or the power paradigm, and the slippery slope. They don't have to be all financial penalties, but you need to make sure that if people are not obeying the law, if they are taking unfair advantage of the relief programs, they are penalized. You need to target these controls. You got to make there's evidence, for example, on audits that an across the board increase in audits may have quite perverse effects. If I'm honest and I'm audited, I might react by saying, this is completely unfair. I'm going to show this tax authority in the future by cheating. And there's evidence to support that. You want to target people who are non-compliant, not people who are compliant. You want to reward tax compliance. You want to, whether or not this is financial or whether or not it is simply by recognition. There's some evidence that rewards are better ways to encourage compliance than equal expected value penalties. And sometimes simply recognition does a good job. Establish cooperation as a socially binding norm. This is the trust aspect. This is, I think, crucial. It's also the hardest thing to do. There's no obvious strategy here. I will confess that. So it's easy to throw this out as a strategy. Exactly how you do that is hard to establish. It requires building trust, and that can't be done overnight. Recognize that framing affects choices, whether something's framed as a loss or a gain, a tax or a fee or a donation. Plan for the future. Recognize that this may happen again. And finally, even though we were planning for the future, and this came up in a paper this morning, beware of hindsight bias. Remember that a lot of these measures were enacted at a time where people were flying blind. You know, jobs were hemorrhaging. People were being thrown out of work. The unemployment rate skyrocketed. And something had to be done. It had to be done quickly. And so are all these policies effective? No, clearly. Could these behavioral insights be incorporated to make them more effective? Clearly. But nonetheless, even though we want to make sure these policies are evaluated ex post, we want to make sure ex post that we recognize that people were acting in a vacuum in a lot of ways. There are known knowns, there are known unknowns, and there are unknown unknowns, in the memorable phrase of previous Defense Secretary Donald Rumsfeld. We were working with lots of unknown unknowns, and so we need to establish some humility and some charity in looking back at these. So conclusions. How will all these tax policy measures enacted be perceived? How will these measures affect future compliance in a post-pandemic world? We conclude in this paper that these measures will clearly affect citizens' compliance behavior, but exactly in what direction, we don't really know. We don't really know. Focusing in particular on kind of the big ticket items here. My conclusion is that there will be increased compliance, largely via improved technology and increased tracking electronic payments. And in those instances where people think government has done a good job and they can trust government. Mixed bag in the US. That leads to the second point, a decreased compliance, largely because the budgets of the tax administration, the IRS, it's been slashed 20%. There's been 30% loss on auditors. and other personnel, they've been decimated. Some high-profile programs have been discontinued. And if people believe that the government has been ineffective, they don't trust the government to do the right thing, that's going to lead to decreased compliance. So which is it? Well, here's where measuring these effects comes in. And here's where my small plug, and I'm about done here, small plug on my own research comes into play. I'm working on using empirical information from across the world on what's been happening on technology and tracking and trust, where there are objective, well, reasonably objective measures across countries, and enforcement activities and so on, and unemployment and income loss, to come up with predictions about what's going to be happening in the next several years by country for compliance rates. That's one effort. Another effort is perhaps a little more pointy-headed, and that's to construct a dynamic general equilibrium and endogenous growth model with endogenous evasion and endogenous trust, where there have been shocks to trust and shocks to social norms that we model, and we trace the effects over an extended time horizon on how these shocks will affect, depending upon particular country specifics, characteristics, compliance going forward. Both of those projects are underway. I don't have results on either one of them, but that's what I'm focusing on. Still, though, to come back to the Donald Rumsfeld point, we're living in a world with far greater nighty and uncertainty than we have known, than we have seen in the past. Not risk, where we can quantify risk, but simply uncertainty. We don't know what's going to happen. Unknown unknowns that are the most challenging to address in the mystery that is COVID-19. And some new events, no doubt, going to come up. A year ago, did anybody think we would be experiencing what we went through this last year? I don't think anybody could have. Most people did not. I certainly did not. What can we predict going forward? Virtually impossible to tell. But I think a behavioral perspective helps inform these decisions and such, and these policies, and I hope that we can learn from what we've done in the past. I will quit there. I went a little bit longer than I should have. I apologize for that. I am happy to stay as long as you would like and to answer any questions that might have cropped up.
Okay, great. Thank you very much, Jim, for that great presentation. So, and of course, like, it's a very timely presentation. Like, we're still in the middle of this pandemic, and like, tax issues are there. So I am going to, like, basically read to you, like, a few of the questions that will, I think, make it a little bit easier for you. Like, so, and I probably have a question, at least like one question for you. So if you have any time at the end, but I'll save mine at the end. So we have one question from Frank Fossen, who is a professor in our department, and he also attended the National Tax Association meetings before. So he's one of us, right? So so Frank is asking, are the COVID relief packages larger in the US than in the countries like France and Germany, because the latter countries already had more comprehensive social insurance policies in place, in particular the unemployment insurance?
Almost certainly that's the case. So, for example, in France, some of the employment protection was channeled through existing systems. I'm assuming that happened in Germany as well. The U.S. it's well established that the social insurance protections in the United States are significantly lower than in other countries. And what was enacted in the U.S. in a lot of these programs was an attempt to essentially on the fly enact social insurance programs, paycheck protection, the unemployment, extended unemployment, for example. Most recently, perhaps even the child credit that was passed in the American Rescue Plan. So that can explain some of it. I think there's no question about it.
Okay, great. A question from Diana Mitrovic, and Diana is working at the Governor's Office of Economic Development. So thank you, Diana, for the question. Kind of a long one, so I'm just going to read it. So she says, thank you very much for the insights. Are the tax administrations changing their thinking and developing with their risk compliance strategies more preventive approaches to better understand and influence the taxpayers' behavior, such as in Ireland, Australia, or in the Netherlands, where the Dutch approach of horizontal monitoring establishes agreements between taxpayers and the tax administration, focusing on cooperation and mutual trust?
Those initiatives are clearly underway and more underway, I think, in European countries, OECD countries more broadly. So expanding the focus beyond Europe. In the United States, I don't think that those initiatives like horizontal monitoring, which I've actually looked at some, and it's had some success, some mixed success, I think, but some success. I don't believe that despite the best efforts of Nina Olson as the taxpayer advocate, I don't think that there have been some significant inroads in the way in which the IRS, the U.S. IRS, has focused on improving compliance. I think those, focusing on my three paradigm approach, it is still largely, if not entirely, the focus of the U.S. IRS to use the enforcement paradigm. And in fact, the services that are provided by the IRS have diminished over the last 20 years. So even the enforcement paradigm has diminished because the IRS has lost funding and has lost auditors and such. And in terms of trust, again, that's where Nina Olson, I think, has tried to make some changes, significant changes in the IRS. I don't think that those have been particularly successful in the United States. That doesn't mean that at the state level, some of those initiatives on either services or trust have not been implemented and have not made some progress. I think they have. I think, my previous state in Louisiana, I think the state government has made some significant efforts in trying to improve the quality of services. I don't really see that at the federal level, to be honest with you. I hope that changes. And don't get me wrong. I think you cannot have a voluntary compliance system without enforcement. That is a sine qua non. You have to have that, and the evidence is decisive that enforcement matters. Not always in the way that the IRS auditors think it does, but nonetheless, it is decisive. It has to be present. And the empirical evidence and the experimental evidence and the field evidence suggests that in most cases, not all cases, more enforcement, more penalties leads to more compliance, but not all cases. And so that's all I'm saying, is that you need other strategies. There's a full house of behaviors of individuals who are complicated, and you need to have policies that focus on those taxpayers who want to be honest but don't know how to be honest. Services. You need to have policies that try to make people realize that doing the right thing is something that they should pursue. And that's more the trust paradigm. So I don't see it happening in the U.S. right now. It's happened more in other countries, like the horizontal monitoring. It's happened in some other New Zealand and so on, but not so much in the U.S. I hope Utah can be a poster child for some of these expanded approaches.
Thanks. A question from Todd Sorensen, who is also a professor in our department. And you may actually know Todd, remember him from your SEA days.
Indeed.
That he's done, and I guess continues to organize sessions as part of the SEA. So Todd is asking, you said trust in government is very important for tax compliance and tax revenues. We think trust in government in general may be a function of the degree of inequality in society. Has there been any work on optimal tax rates that accounts for this? Maybe in the DSG model that you're working on?
The model that I'm working on has as its focus modeling the COVID shock and the way in which that may affect trust and such, and also the way in which enforcement budgets affect the ability to audit people. We have not, this is with a former student of mine who's in Australia, we have not incorporated the potential effects on optimal income tax rates in that kind of setting. That is eminently doable. That's a terrific point. We have not done that. But that is something, and I'll make a note to send to Raul Barreto, my co-author, who's doing the heavy lifting on that. The dynamic stochastic general equilibrium model is far too complicated for me. So I always like to work with people who are smarter than me, like Vivek Adhikari or Raul or some of the other people who may be on this. And I will bask in their reflected glory. So that's a terrific idea. In terms of optimal income taxation in a world where trust in government is incorporated, I'm not aware of anything that's been done there. I think that, again, is eminently doable in the model that I have, but I don't even think it needs to be a dynamic model. I think you can model that in a static model with trust being some variable that affects people's willingness to pay taxes and affects the ultimate tax burden. I think that would be doable. That would be worth exploring in a static sense. And so I would encourage you, Todd, to undertake that. And I will look forward to seeing your work on that. So keep me in the loop.
Great, thanks, Jim. So, well, this one is interesting. It says anonymous attendee. I think I have an idea about like who this person may be. Some countries have historically low level of public trust to governments. For example, young democratic systems in Central and Eastern Europe, because of COVID-19 and very low levels of trust, where their governments increase enforcement efforts with tax policies. Do you think that prolonged pandemic situation can lead to further lowering of public trust and increasing power of governments, which will lead in the long run to shift even more powers to central authorities, more centralization, I guess?
There are several aspects to that question. There's no question there's in my mind that an inadequate or ineffective response to COVID, as in many countries, affects trust in government. And that's not simply in the current environment of COVID-19. I think, if you look at the United States, why do so many people of color, why are they resistant to getting the vaccine? They don't trust the government in terms of what previous government actions have been. Think of the Tuskegee incident, for example. There's remarkable suspicion. There's suspicion, whether it's remarkable or not, of what government's motives and government's effectiveness. And so has that affected the willingness of people to obey mask mandates or to get the vaccine now? Absolutely. Absolutely. Does that limit it to the United States? Absolutely not. That's around the world. But the other aspect of that is, I think, I don't know if this is directly what you asked. Have governments been using COVID-19, the pandemic emergency, as a rationale and excuse and a pretense, if you will, to consolidate more power? And the answer there is yes. And you don't have to look any further than Mehmet than Turkey. I think, for an example of a President Erdogan who's for better or for worse. I'm not making a normative judgment here, but he has used COVID, I think, as a rationale for essentially getting almost complete power in Turkey on some of these aspects of it. I'm less familiar with other countries in Europe, but I believe that there are some examples, especially in Eastern Europe, where the Turkey example is not gone unnoticed. If anything, if our previous president had really, my take on it, had really been interested in centralizing authority in his office as president, while he was president, the COVID was an excuse to do that, and he didn't. for whatever reasons, either because of a lack of interest, or because of the checks and balances in our system, or because of incompetence. Who knows? Who knows? I don't think that happened, despite sometimes claims that are made in parts of the media about that. So I'm not sure if that answered Anonymous here. If they want to clarify, I'm happy to take another stab. But
yeah, that's fine, Jim. Thanks. So yeah, there are like quite a few other questions. I know like we're running out of time, so I'm just gonna try to go quickly. This is coming from a student of mine, Babak Hasanzadeh. So he's asking about the corporate financial reporting. So thanks for the presentation. So difference in corporate tax and financial reports, the GAAP, can complicate tax collection. These complications can reduce social trust. Also, these differences opens lots of ways for tax avoidance, like earning management methods. What do you think about having more book tax conformity in the US?
that's a little bit off topic here. I think the more important consideration, at least in terms of business tax compliance, is probably transparency. And if a simpler form, a more transparent form, a more tax policies that are communicated more clearly to businesses, I think that's probably more important in encouraging business tax compliance. Would book conformity lead to that? It very well could, because it would reduce the discretion, I'm assuming, that individual businesses might have on some components of their tax return, and therefore on their tax compliance. But I would go back to, I think, transparency and simplicity. If that's part of what you're talking about, I think that could be part of a strategy.
A question from another professor from our department, Mark Bingle, and Mark is works in the behavioral economics area, and he's like pretty heavily involved in the SABE. I don't know if you've been to their meetings, the Society for the Advancement of Behavioral Economics, and like he's done exactly before a year or 2 years before the IIPF Congress in Lake Tahoe. Like he's actually organized a SAFE conference in Lake Tahoe. So, but anyway, so he says understanding compliance is important because taxes still fund public expenditures. However, increasingly the US seems to be favoring financing public expenditures with debt. Do you perceive any of your insights on compliance might be applied to understanding the use of debt to finance public expenditure? Or do you think public officials use debt in part because then they do not have to worry about compliance rates?
I don't know. I'll be honest. I think that when one delves into the macroeconomic policies that are emerging, I really think there is a sea change in macroeconomic policies of a fundamental nature. And exactly where that ends up, I don't know. There is far less concern, with the exception of, say, a Larry Summers or an Olivier Blanchard, about the use of debt. And I think that is more or less across the spectrum. You do not see the. I mean, you have the Committee for a Responsible Federal Budget issuing their usual claims about. We're piling up all this debt. I mean, the budget deficit this last year is over $3 trillion, and it's going to be even higher with the recent American Rescue Act plan, and with if in fact there is an infrastructure plan of $3 trillion, almost certainly financed by debt. So is there a concern about the effects of debt on interest rates and crowding out and such? I don't see that for the most part. in macroeconomic discussions, again, with some exceptions. Now, whether that changes if inflation picks up this year, as it almost certainly is going to, and interest rates start picking up, as they almost certainly will, remains to be seen. But I think right now the expectation is these government programs will be financed by borrowing, period. Again, the one qualifier on that is, again, Larry Summers. He has some recent papers and some op-eds where he has argued, and this is not exactly an argument limited to Larry Summers, that there is a lot of money that's we're leaving sitting on the table, and that's money from the tax cap. Now, it's harder to pick up that tax cap money than most people anticipate. You know, the most recent estimate is that the unpaid taxes were $450 billion, $483 billion, somewhere just south of $500 billion. And you project that over multiple years, 10 years, that's a huge amount of money that's being left. Another recent estimate is that the amount of money that we're leaving on the table is over $7 trillion over 10 years. And the way to collect that is to improve compliance. And the way to improve compliance is to increase the budgets of the IRS. There's estimates that every dollar of additional IRS budget will increase tax revenues by $6. I actually am skeptical of those estimates, but I don't think they're that far off. They clearly more than pay for themselves. And so that's an argument Larry Summers and Natasha Saran and Charles Rossetti are making in op-ed pieces. And that's not an argument limited to them. I've been making that argument forever. And I'm making the argument for expanding third-party information forever and so on. But I don't think that is central to the way in which people at the federal government level are anticipating funding the federal responses. So I just don't see that happening right now. I don't see a big increase in IRS budgets, a big increase in compliance. I just hope that the declining budgets are reversed for the IRS. And so the declining and the increasing tax cap becomes a shrinking tax cap. And I think there are ways in which that can be achieved, as I've argued in some of my papers as well.
Another student, this time a PhD student in economics, Irem Sevindik. So she asks, about the like people feeling insecure and about their healthcare and insurance system. So do you think that, like this insecurity may affect the willingness to pay taxes?
Absolutely. If people are fearful of losing their job, they're more likely to hang on to their income and not report taxes. The evidence on that is quite clear. So that's in part, in large, I don't know if in large part, but that's one motivation for government to provide these relief payments, to reduce that source of uncertainty, to reduce that sense of risk that people feel that may reduce their willingness to pay taxes. To the extent that that can be reduced, you're never going to eliminate it in our economy in the absence of a huge expansion of the social insurance programs. But you can reduce the uncertainty that people are facing. And in the process, you can reduce their fear and reduce their anger, and all of which, that's the emotional aspect of tax compliance. All that can lead to more compliance as well.
Right. Jim, well, this is actually my question. So I guess I get to ask at least one question, right? So, I know you've done work about tax amnesties before, and I'm sure we talked about this, exchanged information about this, because I had a student who was very interested and wrote papers about that. You may remember, Harry Lutel. So how about the tax amnesty changing behavior? I mean, I know, of course, you spend a lot of time in Louisiana. So I remember Louisiana was one state that did repeatedly amnesties, at least 4 or 5 times, right?
More than that, actually. No, I am not a fan of tax amnesties. I'm not sure where Harry is on them right now, if he's an advocate or not. I do know that he has some some work with Russ Sobel, whom
Yes,
I know you well remember,
yes,
that looked at
absolutely.
the revenue effects of repeated amnesties. And some of my own work considers that as well, and in a different setting. And the evidence is, I think, pretty clear cut that one, amnesties can generate some revenues. That usually comes largely from people who are already known to the tax authority, actually. But nonetheless, it can generate some revenues. Two, those amount of revenues are hardly ever very significant on a recurring basis, hardly significant relative to the annual revenues that a government collects, usually no more than 1 or 2%. There are of annual revenues. Now, there are some exceptions. Indonesia, for example, had an amnesty 4 years ago that generated maybe 3 or 4%. And that was widely and wildly acclaimed as a huge success. And it was, and Indonesia needed the money, but nonetheless, 3 or 4% that's a one-time revenue increase, and that's not a sustained increase. And three, the long-term effects of amnesties almost certainly are corrosive, because it leads people who want to cheat to think that there's going to be another amnesty. And it leads people who have been paying their taxes to think, I've been a sucker and a chump for paying my taxes. All I had to do was wait, and I could get an interest-free loan and I could pay later on. And so almost certainly, and the evidence on this, I think, is not incontrovertible, but is pretty clear, at least in my work, that the long-term effect on compliance is not to bring these tax evaders into the tax net, but to lead people who have generally been honest to think, I've been a sucker.
Right.
And they respond in the way that you would think.
Yeah,
So I'm not a big fan of amnesties.
right. Well, I remember that, especially for Hari, like that was the angle, right? So like, there's got to be a long-term cost, like, from the behavioral effect from these tax amnesties. Yes, you get some money and you feel good, but the politicians, of course, like think short term. So it is, I guess, easy for them to say that, well, let's do this and have a windfall gain.
Yeah, now I do have one paper where essentially that third point about the long-term effect being negative is pretty muted. And this is the time series paper on Colorado, where we looked at a 10-year period where an amnesty was introduced right in the middle, and we didn't find any impact on either the trend or the level or the whatever following the amnesty. It also didn't generate that much revenue, and so maybe that's a precondition of it. So I'm not a fan of amnesties. I will not go so far as to say that they are always incredibly harmful. I think more to the point, they don't have that much of an effect. And nonetheless, if they have any effect, it's going to be somewhat corrosive to the social norm of paying taxes. And they don't generate that much revenue. Don't use them. Now that generally falls on deaf ears to Louisiana, for example, and most other ones, most other countries, most other state governments. But that's my conclusion.
Well, yeah, thank you, Jim. And speaking of former students, I'm just going to tell you, because you're probably not seeing this in the chat box, that your former student Bibek Adhikari says hi. So apparently he's like, listening to it. And I did share with him, like, and many others, of course, the lecture flyer. So like, it's great to see him, like, in the webinar.
Indeed.
Well, I think that's all the questions that we have. Do you have any other final words that you want to share with us, or?
I just hope everybody stays safe and takes care of each other, of their self and each other, as Lester Holt would say. And I hope everybody gets vaccinated sooner rather than later.
Yeah, let's hope so. Well, thank you very much, Jim. We appreciate your
Thanks
time.
to you, and thanks to you and your crew there for making this a smooth experience and a pleasant experience. And thanks to everybody who attended. Some nice questions. I will ponder them as well.
Yes, great questions. Yeah, I'll like to express my thanks for all these people, what we call the backstage. Michelle, Ashley, and Holly. Of course, I appreciate their help with the all of these webinars that we're doing. So thanks again, Jim, and have a great afternoon.
Thanks all. Goodbye.
Bye-bye.